think we're live now.
Can you hear me,
Uh,
Steve?
now I hear you. Yes. Hey, Josh.
Okay. Hey, Steve, how you doing?
Pretty good.
Nice. Thanks. I'm glad. Thanks for inviting me onto this. I
No,
appreciate it. I'm sorry that my camera's not on. I wasn't fully ready, so my office isn't very presentable. But I am here for you, my friend.
we understand. Well, I'm not that presentable, but we do what we can. No, I appreciate it. It helps to have somebody kind of be the host, make it a little bit more conversational. So it's not just me going through the slides, and then you can kind of maybe speak for the audience if we come across something and you feel like, hey, can you expand on that or whatever it may be. So
Yeah, happy to do that. Also,
yeah,
everyone who's around, thank you so much. If you have any questions, you can chat in. We'll see the chat. If everyone hears us, if you want to just write a Y or a number one, just so we know that you hear us. And Steve will get ready to proceed whenever you want,
yes,
Steve.
here we go. Let me oop, I don't want to skip who I am. Steve Smith. So first of all, yes, thank you everybody for joining. I'm assuming we have some people who said they can see and hear us. Um, so, who am I? Why am I here? Um, I have about 30 years experience in trading. I really got into the business through my family. My father was mainly focused on commodities, had a business. I graduated college. I was an English major. I initially thought, okay, I want to avoid the family business. Went into advertising, got tired of making photocopies for a year um, for $17,000. And, you know, they pulled me back in and I went out to Chicago. Got a seat on the Chicago Board of Options Exchange at the tender age of 23. Um, was also on the Chicago Board of Trade. We traded some commodities and stuff. So I was there for about just shy of 7 years. Um, had my ups and downs, but certainly learned a lot. Acted as a market maker there. Um, then just kind of fell into writing also. So I was able to use some of my English major skills. I had a friend who worked at thestreet.com where, the infamous Jim Cramer launched his company. And he kind of called me during the .com when all magazines and everything, things were going online. He's like, hey, Steve, you still watch the markets? I'm like, yeah, I still trade. And he's like, you were an English major, right? So it kind of meshed two things. And I loved it, being able to trade and then write about it. Now, obviously, everybody has access to it, but that was fairly unique at the time of have somebody who's an actual trader to be writing about it. So I was there for quite a while. Went on, consulted at New Vernon Capital, or still is a hedge fund. This was in the wake of the financial crisis. They did some like risk consulting there, helping them use options and derivatives, and actually learned quite a bit because I wasn't the main guy there. There was some people who were fairly sophisticated. And then I really hooked up with Adam Mesh about 10 years ago and been managing the Options 360 and Earnings 360 newsletters for, like I said, about 10 years now. Okay. So what is Options 360? I like to describe it as that I take an unconstrained approach. So I use my, options expertise and market experience. And what I mean by an unconstrained approach is I'm not bound by a single style or strategy. Whereas you might come across some people who are strictly credit spread sellers, or some people who simply buy or sell, buy outright puts or calls. So for this, what I want to do is be able to use a different strategy, whether that's credits or calendars or iron condors. Don't use as frequently, and you'll get to see. We're going to go through some recent trades, and you'll see what kind of like the staples of our strategy is. But the point is that I want to be able to see whatever the market environment is, and apply the strategy that I think is going to really align with my trade thesis. It's going to, give us the best chance for a profit within whatever the market environment is, and something that aligns with my trade thesis. So if it's a lower volatility market and we're trending, maybe trying to collect income through a credit spread makes sense. If we're like we are now in a higher volatility market, Maybe we do something that's a little bit more, that'll capture a little bit more of an explosive move. So we'll take a look at some trades and how we approach that. Also over different time frames, right? So I have trades that sometimes look out 2-3 months, and some that look out 2 or 3 days. All right. So I've tried to give it a little bit of a cutesy name, the 3P approach. That means process, profit, and probability. Um, and the basic underlying fundamentals of that is, I want to have limited risk, but use the leverage of options so that I can deliver fairly, not necessarily outsized returns. So this isn't going to be a service where you necessarily are going to be like, oh, I made 300%, I made 3,000%. We're not buying outright out of the money options. We're using spreads that have a defined risk, a defined reward, and we want to be consistent. And that's what hopefully you'll see over my track record is consistency is the key, and hopefully and compounding returns over time. So we do kind of try and keep it simple, basic strategies, nothing naked. So I learned my lesson very early on in my career. I sold some naked puts, got blown out. When a takeover deal collapsed, this was 1989. Anybody's old enough to remember when UAL was supposed to merge with Northwestern. Anyway, so I learned that lesson again. I had sold some soybean puts, believe it or not, and Gorbachev went missing, I think, and he was taking a vacation on the Black Sea, and soybeans went limit down. Anyway, so there's never anything naked, and I also don't do lottery tickets of like just buying some out of the money puts or calls and just being like, oh, I hope there's a huge move. It could be tempting. So what do we target, right? So we target trying to have a 65% win rate, which means we do have losses. There are losing trades, and a profit of 60 to 90%, and we try to limit the losses to 25 to 50%. So you'll kind of see this again. So the process is price takes precedence. And what do I mean by that? It really just means that I'm starting with the charts, right? So I'll have a watch list, and it can change, right? There's usually the biggest names are always going to be on there. And then you may have some things that come and go, so a year and a half, 2 years ago, you add some AI names. A little bit more recently, in conjunction with AI, maybe some of the power names, like the nuclear, like Oklo, SMR. A little bit recently been trading some of the satellite names, whether it's Rocket Labs or ASTS. I haven't really traded, but I watched some of the quantum. I'm just not quantum's not my, I think that's still far away and too much hype about it, which leads me to, I do look at the fundamentals. That's not going to trigger the trade. It's going to be the chart and the price. But I do like to do some research just to understand what the company is in terms of valuation, and so and the story behind it. What's the narrative? So where might my risks and rewards lie, and what could be price catalysts? I know a lot of people who are purely technical traders. They might not even know what the company does, and it just simply doesn't matter to them. I just like to know, kind of what pool I'm swimming in, and where the sharks might be and where the mermaids might be. The next step would be in the process is to do some options analysis. So look at like volatility levels in terms of, where is it historically? Is volatility high, both realized and implied? And how's it deviating? So that'll also kind of inform of what strategy, leads towards identifying a strategy that would best align with my thesis. So again, it would be something, it's trending, volatility is kind of in the middle, so we are getting premium. Let's use a credit spread. Oh, volatility is very low. I think there could be an explosive move. Let's do something, a debit that gives us a little bit higher leverage and profit potential. And this kind of repeats those numbers. So again, these two P's kind of go together, is the probability and what is the profitability. And again, the numbers that I'm shooting for, and that's pretty much what I've achieved over the last 9-10 years, is that winners should outpace losers by about 60 to 40. I want the winners to have returns of 45 to 90%. And the losers I want to try and limit to 25 to 50%. Obviously, sometimes something, they may go bust or something may fall in and we can have 150% return. So, but these are the basic, over time, these are the numbers that have kind of played out. And if you do that, you can end up having returns in the 50 to 80% return per year. And so how have I done with this service? And I'm going to break down this because I think it's important to understand. This is also a function of, sizing and your allocation and how that works towards your return. So you can see that, 2015 was a monster year, 122%, 2016, 88. And we kind of drift down over the years. But each year, I'd like to point out, like 2022 was a bear market. I think the market was down 25%. We still had a 41% return. 2023 basically kept pace with the S&P, maybe did slightly better. Same with, I forget, 2024 was probably about there. And this year, we're up about 12% with the market, let's call it flat. So one thing I'd like to say is, as those returns, which I'm very proud of, it's consistent. And again, the S&P isn't necessarily my benchmark because I'm shooting for absolute returns. So to try and frame what these returns represent is, each year I reset the portfolio to $10,000. This way, everybody comes in, at the same level, and also it's less intimidating than saying, oh, we built up this account and it's now a $100,000 account, or it's 200. So I want to be able to reset and show how I might allocate a $10,000 account, which is any one trade. I don't want to really have anyone trade more than 2 or 3% of the portfolio, and at any given time. So that would mean, each trade is about $200 or $300 per trade. And I don't want to have probably more than 5 or 6 positions at any one time. So realistically, you could do this with probably a sub $5,000 account. So I like to say, it's a lot easier for people to scale up as they get comfortable than for me to introduce some service and try and throw out big numbers and say, and somebody be intimidated and be like, oh, this isn't for me. So one of the reasons over the last couple of years that the returns have come down and kind of reverted is the market got more volatile. Certainly, like, post pandemic. I mean, we had a good year in 2021 because it was a booming bull market, and that always makes it easier. But recently, with a little bit more volatility, I've really been allocating even smaller. So may only be allocating 1 or 2%, even as the account grows, 1 or 2% rather than 3 or 4% per trade. So at any given time, I'm using probably, if it's a $10,000 account, at any given time, I'm using less than half of the account, which gives us a cushion. So, but if you had joined, and we can talk about compounding your gains, and as your account grows and you scale up, you could say, if you had joined in 2015 and scaled up appropriately, you've compounded your gains and you'd have over $580,000 today. Okay, so that's the performance. Let's look at how we got there with a couple examples of trades. This was a while ago, but I use it because I broke down. This is a bullish diagonal spread in Morgan Stanley. Now, for those who don't know, a diagonal spread is one where you go out and you buy a put or a call. In this case, it's a call. So on June 5th, we went out a month and we bought a July call. And simultaneously, we sold a June call for the weekly. So we created a spread where we go out. Here's my hand. We go out in time and buy a call, and then we sell something for income and create a spread. And so what that does is it gives us the ability to both benefit from a directional move or appreciation in capital, I would say, or and also benefit from time decay and income collection. So one of the analogies I know Adam loves to use is think about it as buying a building. So the call that you buy out in time is like buying the building. The call that you sell that has a shorter duration is like renting out an apartment. So you hope to have the building that you own appreciating capital, and then you collect income through the rentals. So what we did with this, we ended up having, and I think I can show it better on the next slide, is we ended up having three what's called rolls, where we buy back the weekly we sold and we sell the next one. So, right. So it's like getting a new tenant. So just to break down, we initiated the trade on June 5th, I believe it was, and we closed it out on 4 weeks later. And you could break down, where did our profit come from? We had a total return of 75%. 44% of that was derived from the directional move of the stock moving higher, which you can see on the chart, right? We entered it here. The stock didn't have an explosive move, but it did move higher. But during that time, we also collected income with these rolls, right? We sold a call, sold another call, sold another call. And so that accounted for 66% of our return, and totaling a 75% return over a month. So these diagonal spreads are kind of like our bread and butter strategy. So let's look at something more recent that we did in the SPY. And in this, we've been able to utilize that there's daily options, right? So this is straight from an alert. I send out, you get it in a text message and also an email. So say SPY, it was currently trading on January 13th. It was trading 576. And you could see that basically it filled the election gap. So we'd come down pretty hard. We'd given back all of the post-election gains. So that seemed like a good support area. So I said, looks like a good spot to get a bounce. I spell out what the action is, what order you should do. So what we're doing was we were buying a January 17th, 580 calls. So we went a week out, bought some calls, and we sold the next day, right? The daily, we sold a call that expires on 114 at the 582 strike, and we paid a net debit of 285. All right. So we bought a call that's a week out, and we sold a call that expires the next day. That's the diagonal. The next day, what we did was we rolled the short call, right? So we bought to close the 582, because now you can see, right, the SPY already jumped, moved up, and then we sold the next day. We sold the 115 call at the same strike, 582, and we collected $1.80. So our new cost basis is just 85 cents, down from 285. So we've already taken a huge chunk of income, reduced our risk and cost basis, and we still have a $2 wide spread that only cost us 85 cents. The next day, January 15th, the SPY jumped probably another 2%, and now we're at 591. So we've moved up something like 25 handles from when we first put on the trade. So we say it's blasted through our strikes. Let's book a profit, and we closed the trade for 270, and that gives us a 98% return over a 3-day holding period. All right. All right, let's look at kind of the opposite of that trade is a credit spread that we did in Apple, bull put spread. Again, we can look at the chart on the right. Again, I say I start with the charts. So what was I looking at? Apple had come down dramatically to what I considered a major support level. I can read, I don't know how well you guys can see from the alert on January 21st. Apple has suffered a precipitous 15% decline since Christmas, with concerns about iPhone sales, especially in China, and there's very little traction for its AI offering. It trades at a very rich 32 PE. I said, but that said, the 220 is a good support level, and I don't think it will be smashed much heading into its earnings report next week. So let's establish a bull put spread, go right at the money with a short-term bull put spread. So we sold 2 contracts of the 220 puts, right? So we went right at the money. The stock's trading right around 220. So this is a fairly aggressive credit spread. And then we limited our risk by buying the 215 put, and we got a 145 credit. So, and this is going to be kind of important. Within 2 days, Apple had bounced. Again, you can kind of see the chart. This is a couple days later. Apple looks to open above 224. And we entered an order to close it for 20 cents. So the return was on the 2 contracts was $220 or 91% of the max profit. But this is very important. Is that when you look at credit spreads, how you calculate your real return, which is return on risk, it was only a 45, I should say only, it's a 45% return. That's because we made 220, but we were risking 260, right? And that's because we collected 145 on a $5 wide spread. So we'll look at another one of those because I think it's important, because a lot of people who really promote credit spreads with ink to be like generate income, they think, oh, I sold something for $1 and it went to 0. I made 100%. No, you didn't, because I don't know how wide the spread was. You might have been risking $4. You might have been risking $2. I don't know. So you need to, on your, calculating returns, I think that's just good for people to know who may not be familiar with, and they hear from people who talk about credit spreads and they made 80% and they made 100%. You need to really look at it from a return on your risk, not that you collected all of the premium you sold. All right. I just kind of I don't like to see people who are out there trying to sell option services give misinformation. All right. I show this just to show that sometimes we don't do this often, but a different strategy. It's called a risk reversal. So this was in the satellite company, ASTS. I'm not going to read you what the alert says, but again, this is part of when I do an alert, I want to give some background about why I'm doing it. It's not just like do this trade and follow me blindly. So I want to give you some background about my thought process of like, why am I doing this? But what I want to focus on here is the structure of the trade. So what we did here was we sold a put spread, right? The 19 put we sold, and then we bought the 17 put, right? And that helped finance the purchase of the $23 call, all for the same expiration. And we went about 3 weeks out. And this only cost us 10 cents, right? So we didn't have to outlay much money, but be aware our risk was $1. Our risk was actually $1.90, because if we went down to 17, this is $2 wide. So we did have risk here. It's not It's not that we only paid 10 cents. We did have risk here, but it was limited. But this gives us unlimited upside, right? And the reason I looked at this was like looking at the chart. It looked like a big bullish flag. 2 or 3 weeks later, there was some piece of good news. The stock popped when they signed a contract with AT&T and Verizon. The stock was up 12% that day to 22, and we closed it for 47% profit. All right, so took a little bit of while. It took a couple of weeks, but we did get that kind of explosive move that we were looking for. That a risk reversal gives you unlimited upside. Okay. Here's another credit spread. So we started to trade a little bit more SPY as things got more volatile instead of trying to stock pick. Though I'll show you some of our current positions. We do have a couple individual names. Again, I don't want to so much read the whole alert, but SPY was trading about 570 on March 19th. And the key to this was we'd approached the 200-day moving average that I just didn't think it would really be able to burst through while there was so much unknowns about tariffs and everything. So what we did was we sold a bear call spread for a credit. So we sold the 577, bought the 588 to limit our risk. We collected 95 cents. 2 days later, we had a big drop. I'm sure there was a tariff tweet, helped the market collapse. And we covered that for 10 cents. So again, you have to look at why, we sold something for 95 cents and we covered it for 10 cents. It's a 41% return because our risk on that, it was $3 wide. We collected 95 cents. So that means we were risking $2.05. So we made 85 cents on a $2.05 risk. That's a 41% return. So don't let anybody, again, this is like a pet peeve of mine when people do credit spreads and they say, I made 85%. You didn't make 85% because you were risking $2, let's just round it to $2. All right. Great. And we'll end with this, and then hopefully you guys will have some questions. Pick my brain a little bit. Recently on March 21st, last Friday, Tesla trading about 242, not the exact low, but it was bouncing pretty good. And we entered a bullish position. We went out in time, and this is really just to show not only the flexibility about being like, hey, let's we're using the charts, using some of what we some of the background narrative, like I said, and now we went out in time and we just bought a straight vertical spread that, as I say here, let's use a longer term vertical spread we can set and forget, with the thesis that somewhere in the next couple months Tesla could get back up to above 300. So we paid $4 for a $15 wide spread, the 285 versus the 300. And timing was great. Stocks trading, immediately traded like 270, moved up to 280 today. After a small pullback yesterday, about 290. So we did make an adjustment. I don't want to just throw numbers, but we made an adjustment today to cut our cost from $4 to $2, and we still have plenty of upside. All right. So again, here's the returns by year, very consistent, not trying to, I hope some of those examples showed how we can have a trade that, generates income, has different time frames, isn't looking to hit home runs, trying to be, risk management always comes first, and just uses options to, get that edge, get the tailwind behind us between time decay and the leverage of having a limited risk, but opening up, really good profit potential. So what do you get? I think I had something. Maybe it was removed. Oh, here's recent. Yeah, so recent trades, just to give you an example of like what we've been trading over the last month or two. We had that spare butts. I think this was Okta was the next one, so it was an 18-day holding period. Docu, we ended up having a loss, 25%. Again, those are the numbers, right? I want to have wins. I want to be in the 45% gain. Losses, I want to contain to like 25, 30%. So here's something we held for 21 days. It was a 25% loss. All right, it happens. McDonald's was a bearish trade, 32% gain in 16 days. SMR, again, that's one of the nuclear companies. So we've been trading that. We had a 52% gain during a 16-day holding period. Um, Netflix, Iron Condor, which we didn't discuss, but that's basically two credit spreads, 8-day holding period. Butterfly, which we don't use that often, but it was a good opportunity. That's a very low cost but super high reward trade. It didn't work out, but we took a 23% loss, very manageable. In dollar terms, it was something like a $40 loss. It was a $100 trade we put on that we could have made $400 on. So it was, you know, very high risk reward. But we cut our, took a $23% loss in 2 days, and the bear call spread. So I think we did another one after that. All right, I think that covers it. So we did the returns. What do you get? Is I'll write up Monday, usually kind of recap our positions. The typical pace of trades is 2 to 4 trades per week. It's been a little bit less new ones recently, just because I don't want to get too caught up in tweets. We'll see if April 2nd with, tariff day, every day is tariff day. We'll see if April 2nd acts as some kind of clearing event and gives us some clarity. And that's why, also why I like to kind of know the stories behind the company, the narratives, and a little bit of do some research. It's like who's really being impacted by some of these. So like we've had a position in Uber recently, even though it's like car connected, they're not really impacted by tariffs. So it's been holding on pretty well, and we took a roll. That's an aside. You get the so each trade you get an alert, just like I showed you. They come out, you sign up for both texts and so forth. You have access to the real-time portfolio, which tracks every trade, and then twice a month, which we may increase that a little bit. I do a live call, so we may increase that a little bit to maybe once a week or even one time. Those are usually done after the close. So we may do that, may add something where I do one during the week while the market is open. All right. So this is at the point where, Josh, can I turn it over to you
Yeah,
to
Steve,
help?
there's actually, I don't know if there's an issue with something, but I'm getting some questions. I don't know if you're seeing
Oh,
them. I feel like you're not. So yeah, I'm happy to go
no.
over this. Everyone, I've been working with Steve for a very long time. I can help with any questions related to Options 360. I love watching these webinars. But before we do that, Steve, is it okay if I just ask a few questions from the
Oh yeah, I
customers?
have the comments up, but I don't see any necessary
Yeah,
questions.
Patrick says they're coming in some back end system. We don't
Oh.
understand that stuff. We just get it. And
Yeah.
someone said I was late to it, but I was wondering if you covered how much do you risk per trade, and do we suggest how much to risk if people ask us?
Yeah, so like I did kind of cover it, that the account each year is reset to $10,000, and my recommendation for whatever size is no one position should be more than like 3 or 4%, and typically I'm more like it's 2% for your portfolio. And at any given time, I may only have like 4 or 5 positions on. So really, at any given time, I'm using less than half of the available cash, which, when you try and fit this in, this is not going to be your main account. Where like, your investment account should typically be 90% invested over time. So this is really a side account that I think you want to keep powder dry for when just in case something, we have limited risk, but you don't know when you want to may be able to deploy more capital. So, some people are more
That makes
aggressive and
sense.
they say, I have a speculative account. I want to use 50, 80% of it at any given time. I'm more like, I want to use 50% of it at any given time, just so I
Right,
have that cushion.
and you're comfortable with people making their own decisions. I think the
Yeah.
best advice you've given is you can make some of your own decisions, but stay consistent with it. If you're going to shoot for 80% when Steve is only going for 50%, understand the
Yeah.
risks that you
But
might
yeah,
get a little more, but you might. So I always say that to be consistent. Someone asked how
yeah,
many trades per week. I say it's 1 to 2 usually, right? But you could, but it
yeah.
could be 3 1 week and 0 1 week.
Yeah. So we usually will have, and as far as initiating a new trade, let's call it like 1 to 3 new trades, and then you'll typically have one or two adjustments during the week. But this is the also the nice thing about this. This isn't you have to sit there in front of your screen. This is different from a lot of the other services that are done through Adamesh Live or T3, where it's live trading. So it's a little bit more of like a lifestyle service that you know you can trade through your phone. Everybody, I assume, and you get the alert. I'm not going to send something out at 2 minutes to the close. Usually the alerts come out, maybe an hour after the opening, and certainly within like an hour or two before the close. And they have those, as you saw, they have specific price limits. And you enter it. So you don't have to monitor it. You don't have to sit there by your screen or schedule a time where it's like, oh, it's the, the the live trading room is coming open. I need to be there. I don't want to miss it. So you go about your day, the alert hits, and you take action. And just go back in terms of allocation. So within that, again, it's more about not what you're shooting for. It's about what do you allocate and sizing a position. It's like I said, it's really like to look for like 2% of your portfolio per position. So that would be $200 to $300 risk on a $10,000 portfolio per position. So it's really pretty conservative. Some people get a lot more aggressive, but I don't want to be that concentrated. I all right. Any other questions? Josh, did you have some other questions that I couldn't see? I think you have to unmute yourself.
Thank you. I said I lost connection. Then when I came back
Yeah.
on, I guess it automatically muted me. Can you hear me now?
Yes.
Okay, I apologize for that. You actually answered like 3 or 4 questions that people had right in a row. People were asking about how we notify, and I specifically wanted to mention we tell you what to do. It's over email. You could sign up for text alert also. And someone asked me my favorite question for you. Again, Steve and I have worked together for a long time. Steve's best qualities are obviously the trading aspects and the education aspects, but maybe the third one is something very near and dear to my heart. They asked, "Can I ask Steve questions over email?" Steve is absolutely one of the best people in the world to answer you. And sorry to offer your services, but answer you quickly. And he'll answer you if you tell him I'm brand new, he'll answer you in brand new terms. If you tell him I've been trading for 30 years, he'll cater the answer to make sure he's not explaining to you level one. But Steve, is it fair to say that you encourage people asking you questions when they have them, that even a beginner, if they ask you a couple times how to do this, would be able to figure it out?
Absolutely. If somebody doesn't understand something, it ranges from not understanding something, um, from just a mechanical standpoint of entering a trade, conceptual of why we doing this, if I didn't
Mm-hmm.
explain it well enough in the trade, or what, in the last couple of days I've had some things where, and it happens over time, somebody, they missed an adjustment or something, and then the stock moved, and they'll write to me, I didn't get that roll, I didn't get that adjustment, and it's here now, what should I do? And I'm not giving individual advice because we're not allowed to, but I will answer. In the last week I've probably had 3 of those, and I answer within a minute about, like, this is what I suggest, you know
Yep, yeah, and it
wink
really
wink.
is a minute. It's really out of
So
control. By the way, some people are actually asking specifically how to join. It is on the page right now, the website to go to. I'm going to type it in the chat also. You can go there, adammeshlive.com. /360 yearly. That's the yearly option. There's also a quarterly option I could send out
I'll
in
show
there.
you that.
Very important also. It's $199 for 3 months. You see that's the deal. It's a very special price that we're offering you guys. We want you on this webinar to understand, see the value of it. Okay. We're always around for questions for you. And also specifically, again, I want to say the website for you guys, because a couple people are asking. I don't know why they can't see it, but it's adammeshlive.com/360 -yearly or 360 -quarterly. And those are, thank you, Patrick, for posting that just now.
So
I'm just checking questions again. Yeah. Sorry.
So just to emphasize also, I'll do a little, put my sales hat on for a second. If you do take the yearly, which gives you a bit of a discount on the, on the rate, you also will get a quarter of the earnings 360. And that's, I'm not going to get into exactly, the whole detail, but that's something where we just focus on earnings trades. And the next
Can I jump in there for a second, Steve?
What?
About the earnings, very good stuff for the earnings. A lot of people that I talk to have said they're interested in earnings. They know there's a lot of opportunities, but they don't see a lot of opportunities to really learn it and then get consistent with it. Almost every one of these people who try out the earnings 360 service, which is coming as a bonus for this, which is really ridiculous. They might not everyone loves earnings. That's fair, just like everything, but you're never going to wonder about it again. One session with Steve with these earnings, you will learn. You're getting trades just about daily. Sometimes more information you could understand. This being thrown in as a bonus. Again, even if you don't end up loving earnings as much as Steve does, and some of the customers do already, you'll find out everything you need to know about it and if you should look at it. I just want to get in there. Really, a lot of people have earnings questions, but they don't do anything about it. This is a good way to jump in and find out if it's right for you.
And I have mixed feelings about earnings. I'm joking. It's a love-hate. It's a love-hate relationship.
Yeah, as is most of the market, but yes.
Yeah.
Very easy. The love-hate is very easy, especially in this kind of market.
Yeah. But it's good, you know what? Because it's also it becomes kind of uncorrelated, right? So especially during like a bear market or very volatile market, you have that very isolated trade. That even though sometimes it doesn't make sense about the reaction, but it's like a way to diversify your trading. Another way, just like with my positions, I might have a combination of a credit spread or a debit diagonal, and they have different time frames. With your trading, you throw in some earnings tradings. It's like just a way to diversify where you are, so you're not just piled into. A lot of people, especially recently, they loved when the market was going up in all of these Momo names, and then it reverses, and they find it's like, oh my God, I was really overweight in one way, and you just, like anything, whether it's long-term portfolio or even in an active trading account, you just don't want to have everything on one side of the ship.
Yep, that makes good sense. Steve, also, let me just jump in for a sec. There are a couple of people who are asking if their payment actually went through. I just want to let you know, Johnny, you're good. Who else? Lou, you asked about it, and Cage, you asked about it. You guys are all good. So far, it looks like a bunch of people have joined. No issues. If you attempted to join, you should be getting welcome emails soon. And thank you. Sorry, Steve. Go ahead.
Thank you. No. This is the important part here. So see, just for those who've joined, I would say, we have a couple open positions, in terms of what you can expect. I'm also a little bit like, do I want to wait till next Wednesday for this clearing event of April 2nd, instead of trying to play 3D chess of what's being priced. So I don't know. We'll see if there's,
Yeah, people are asking about that too. Like this
market.
Like, is this service good for this market and why? And you kind of did talk about it, and I know I'm biased.
Yeah.
But yeah, because people are currently worried about today's market, and a lot of people are just waiting, like you said, and it could be a good idea to do so. But you think this service? I mean, I know it is because I see it. But this service is doable now. Obviously.
Yeah, because it's opportunistic. I'm going to be patient. I'm not going to force trades. Like I showed you, we took a bearish trade after we had a big bounce. We were in it for 2 days. We do have, right now we have a Tesla position that's out 4 months. So it's trying to be thoughtful about it without and being active, but not forcing positions and not being, hasty. And I don't want to be, yes, I want to be smarter than the next guy, but I don't want to be overly predictive and think that I can guess, do
Yep.
three steps ahead about like what's priced in, what's Trump going to tweet next, and how's it going to react.
If you could predict that, my friend, you wouldn't
Yeah,
you wouldn't
so
be
I
you
mean,
wouldn't be having to predict this.
I don't
Everyone
want to
trusts
have
you.
to
By the
go.
way, Susan, you're in. I don't know if you saw it. Susan, I can confirm. Thank you so much. I don't know if you see it, Steve. Susan
No.
joined and she said, "I love this. I really love this webinar." Said
Oh,
thank you. I assume she's talking to me. Thank you, but I'm sure you're part of it.
thank you. I appreciate it. Yeah, I'm not seeing some of the. I see your comments, and I'm on the comments. I see a couple. I saw somebody say hello. Sorry, I'm late. I saw that, but okay. Thank you, Susan. Oh, yeah. So I don't want to try and predict 3 steps ahead of something, but if we get to certain levels again, it'll be about the charts. And I do look at one of the reasons took a trade was the VIX kind of hit things. There was a confluence of things that when it looked like wasn't the complete washout that people were expecting, but we had a couple things came together last week that I didn't really capture it that well. But the big move on Monday, um, you know, you'd look at a couple things. VIX having hit 30, we had a 90-90 day, even though it wasn't that big an up day on the previous Friday. 90-90 being 90% upside volume and 90% positive breadth. And those are usually, kind of turning points. And the VIX pulling back pretty sharply from 30. Though, right now I would say, if we want to talk markets, well, you guys are deciding what to do. The VIX staying kind of firm. I mean, today's a down day, and yesterday was a down day, so yeah, it should be. But even on the rally day, the VIX was staying relatively firm, which it makes sense. Realized volatility has been really about 20, so we shouldn't be getting much below. If the VIX is, let me look right now on my other screen. The VIX at 18, excuse me, a VIX at 18 and a half is not that rich. So people interpret it in two different ways. But right now I feel like I like the way it retreated, but right now I think it's not necessarily rich enough based on the realized volatility. And so that may be a little bit of complacency in that sense. So.
Okay. Good. Sorry, I'm just answering some people in
Yeah.
chat.
Oh
Sorry,
no,
sorry, I'm
please.
not with you.
Yeah.
Actually, let's give people a minute or two to sign up. When we'll come back and just do a quick little wrap up. But go make some minute rice or something, and then come back, and then we'll just do our final thank yous and see if anyone has final questions. Is that okay with you, Steve?
Oh yeah, I'm supposed to go make rice.
I was just joking there. And
You know what? Well, and then I'll let you answer. I once worked with a guy, and he used to do an earnings service, and he would come on in the morning, and he'd be like, "Hold on," he'd be doing his call, and he'd be like, "Hold on, my oatmeal's boiling," and I
oh
was
boy.
I was the moderator for him, and that's how I actually got into doing earnings. I saw how poorly he ran this. So this was in like 2017. So I've been doing the earnings since like 2018. This is a different company. And I introduced it to Adam.
Thank you for pointing that out. Yeah.
Yeah, this is a completely different company. And I kind of recently started working with Adam and had this options 360. And I saw how poorly this guy was doing. And I went to Adam and I said, Adam, you wanted to think about an earning service. And he was like, no way, too risky. And then I explained my approach to him that it's only spreads, limited risk, trying to capture. I don't want to get into it anyway. We did it, and it's been very successful. But it was thought it was like a funny story when you talk about making money. It just reminded me of this guy going, "Oh, my oatmeal's is boiling," and everyone's like, "We're trying to trade the opening on earnings, and
it's
you're
the
making."
least important thing. Yeah, that's not a lesson. Lesson number one: no oatmeal at important times.
Yeah, it's like 9:31, and he's eating oatmeal. Okay.
Good. I think that served us 2 minutes for them to go do what they got to do. So that was a nice little a little break. Yeah, I'm going to start wrapping it up because it's time to end soon. I don't see any more specific questions coming in. A bunch of people joined. Thank you so much, everyone who joined.
Yeah.
We're still in the first 50, so everyone who's going to join from this webinar is going to get the Earnings 360 service. Take advantage of that. Telling you, even if you don't end up staying with it, you can even cross it off your list of something you don't want to stay with. And in the other side, it might be great for you. Options 360 is one of my favorite services. It's simple. Steve does a lot of the work for you. He's going to tell you what to do. He's going to be there to answer questions just like me. I put my information in the chat. You guys can call me or email me. If you're on the fence, give me a call. I'll be happy to make sure you know that you're not alone in this. You got a safety net under you. You have a parachute. We're taking the jump with you every step of the way. That's really it. Steve, do you want to have if there are any questions, now's definitely the time. If we don't get to your question or somehow we missed it, contact me in my email, josh@adammesh.com.
I mean, I could put my email, Steve, if anybody wants to contact me directly, mesh.com. Please reach out to me at an email. I'd be happy to respond. And like I said, anytime during the course of the day, I take a walk occasionally, but I'm pretty much at my desk most of the day.
God bless, my friend. Me too. That's why we both answer emails quickly. Take advantage of our lack of mobility, guys. Yeah, Steve, if you're good, I'm good. Also, this is recorded. If anyone needs a recording, you let us know. No question about it. We'll get it done. I think it gets done pretty quickly. Take advantage of this, guys. It's a special deal. Both of them, the quarterly, the annual. These are both discounted rates. The free Earnings 360 as a trial. Take advantage. We're always around for you guys.
I appreciate it. Thank you so much for spending the time with me, Josh, and thank you, everybody else who came here.
My pleasure. Thank you, Steve. And yeah, thanks, everybody. I'm going to get out of here. Thank you guys soon. Steve, I don't know how to end this, so I'm just ending. You got it, okay?
Yeah, I think Patrick will do that. So
yeah, I know.
thank